Welcome to the Deep Dive. We're all about cutting through the noise, getting straight to the essential insights you need.
Making sense of it all.
Exactly. And today, we're tackling something that sounds maybe a bit technical, tax loss harvesting.
Right, it has that jargon feel.
But honestly, it's a surprisingly straightforward technique, and it can be incredibly powerful for your investments.
Yeah, this isn't just finding a few extra pennies under the sofa cushions. We're talking about adding real value.
Real, tangible value to your portfolio, and crucially, without taking on more risk. It's, an edge a lot of people miss out on.
And it's maybe more relevant now than ever, given how complex everything feels financially.
Okay, let's dive in.
So what's fascinating here is that understanding this stuff, these strategies like tax loss harvesting, it's not just for Wall Street pros anymore. It's really about making your own money work smarter for you as a genuine advantage. And for today, we've been digging into some great material, mainly tax loss harvesting, a guide to investment efficiency.
And we're going to pull out the key takeaways for you.
Yep, the essential nuggets.
So let's start at the beginning, tax loss harvesting. What exactly is it, in simple terms?
Okay, think of it like this. It's a technique, really a strategy, to make your taxable investment accounts more efficient.
Taxable account, so like a regular brokerage account.
Exactly, not your 401k, not your IRA, those are different.
Got it. So in those taxable accounts, what are you actually doing?
Well, instead of just sitting on an investment that's, lost value, a paper loss, you strategically sell it.
Okay, sell the loser. Why?
To lock in or realize that loss. And you use that realized loss to offset taxable gains you might have somewhere else in your portfolio.
Ah, so if I sold stock A at a loss, but stock B made a profit.
The loss from A can cancel out the gain from B tax-wise, reducing your overall tax bill.
Which means you keep more of your returns.
Precisely. It's proactive. You're turning that market dip, that loss, into a valuable tax asset. It helps boost your portfolio's growth over time because less is going out in taxes.
It's about the after-tax return, isn't it?
Absolutely. If we connect this to the bigger picture, that's the number that really counts, what you actually keep.
We focus so much on the big gains, the gross returns.
Right, but taxes can take a huge bite. Tax efficiency is about maximizing what stays in your pocket, compounding for you. This is a key part of that.
Okay, that makes sense. It sounds pretty beneficial. So why isn't everyone doing it? Is there a catch? And, how do you actually do it? What are the steps?
Great questions. And surprisingly, there isn't a huge catch, really. It's more about knowing the rules. I think maybe people just don't know about it, or it sounds too complex.
Yeah, maybe.
But our source lays it out really clearly, just 3 basic steps.
Okay, walk us through them.
Step 1, find an investment in that taxable account that's down, trading below what you paid for it.
Your unrealized loss.
Exactly.
Yeah.
Then you sell it. You make that loss official. You realize it for tax purposes.
Okay, sold. Loss realized. Step 2.
Step 2, use that loss. First, use it to offset any capital gains you've realized elsewhere. Dollar for dollar, sold something else for a profit, poof, that gain is reduced or eliminated by the loss.
Okay, cancels out gains. What if my losses are bigger than my gains?
Here's where it gets even better. If your losses exceed your gains for the year, you can use up to $3,000 of that excess loss to offset your ordinary income.
Wait, hang on. Ordinary income, like my salary.
Yep. Your salary, other regular income, up to $3,000 of those investment losses can directly reduce that taxable income.
Wow. Okay, that's pretty significant.
It really is. And it doesn't stop there. Let's say you have even more losses left over after offsetting gains and taking that $3,000 against income.
Yeah.
Those remaining losses aren't wasted. You carry them forward indefinitely.
Indefinitely. So I could use losses from this year, maybe 5 years from now.
Absolutely. Until they're all used up against future gains or that $3,000 annual income offset. It's like building up this tax loss bank account.
That's powerful. Okay, but step 1 was selling. I don't want to just be sitting in cash, missing out if the market bounces back. What's step 3?
Right. Crucial point. Step 3 is immediate reinvestment. You take the money from the sale.
The proceeds.
Yes, the proceeds, and you immediately reinvest them into a different security. Something that keeps you aligned with your overall investment strategy, your asset allocation.
So you stay invested.
You stay invested. Maintain your market exposure. So the example from the source was, say you sold a tech sector ETF at a loss.
Okay.
You might immediately buy, say, a a broad S&P 500 ETF, or maybe a different tech fund from another company. Something similar in purpose, but critically not the same.
Got it. Keep the market exposure, just swap the specific holding.
Exactly. And this raises an important question. How different does it need to be? Which leads us perfectly into the main rule you need to know.
Right, because that step 3 is brilliant. You
Yeah.
bank the tax break, but you don't mess up your investment plan by sitting in cash.
And done consistently, especially when the market dips, it really adds up. Our source mentioned a statistic. Systematic tax loss harvesting could add something like 0.5% to 1% per year in tax alpha.
Tax alpha, meaning better after-tax performance.
Exactly. Just from being smart about managing losses,
Yeah.
that's a real edge, and you didn't take on any more investment risk to get it.
That 0.5% to 1% compounded year after year.
Yeah.
That makes a difference. Okay, but you mentioned a rule, the catch, if there is one.
Well, not really a catch, but a very important rule, the IRS wash sale rule.
Oh, yes, the wash sale.
Yeah.
Sounds ominous.
It's designed to stop you from, well, gaming the system too easily. It basically says you cannot claim that tax loss if you buy back the same security or something the IRS deems substantially identical
Okay,
within 30 days before you sell for the loss, or within 30 days after you sell for the loss.
so wait, 30 days before, 30 days after, plus the day of the sale. That's like a 61-day window.
Precisely. During that 61-day period, you can't buy back the thing you just sold for a loss or anything too similar.
And if you do,
The IRS says, nope. They disallow the loss for that tax year. Basically, they figure you didn't really get rid of your economic position if you just bought it right back.
okay, that makes sense. But you said in step 3, we reinvest immediately. How does that work with the 61-day rule?
Because the key phrase is substantially identical. You can reinvest immediately, just not in the exact same thing. You need to pick something similar enough to keep your market exposure, but different enough to satisfy the IRS.
So, substantially identical.
Hmm.
That sounds a bit fuzzy. How do we know?
It can be. The clearest guideline is don't buy the exact same stock or the exact same mutual fund ETF. Also, probably avoid another fund that tracks the exact same narrow index.
Okay, so if I sell, say, Vanguard's S&P 500 ETF.
You probably shouldn't immediately buy Schwab's S&P 500 ETF. Too similar, tracks the same index.
Right, but maybe I could buy, like, a total stock market ETF instead.
Hmm.
Or a large cap growth fund from a different company.
Exactly. Those are generally considered different enough. They give you broad market exposure or large cap exposure, but aren't tracking the identical index. You maintain your strategy without triggering the wash sale.
Okay, that's a critical distinction. Choose a replacement that's similar in function, but not identical in structure.
Yes. And another little warning from the source, a practical tip, watch out for automatic dividend reinvestments.
Oh, good point.
If you sell Fund X for a loss, but a dividend comes in 2 weeks later and automatically buys a tiny fraction of a share of Fund X.
Uh-oh. Wash sale violation.
Potentially, yes, for that small amount at least.
Yeah.
So the advice is to temporarily turn off dividend reinvestment for the specific holding you harvested for at least 31 days after the sale, just to be safe.
Wow, that's definitely something easy to forget. A small detail, big consequence potentially. Okay, so avoid wash sales, reinvest smartly. When should people actually look for these harvesting opportunities? Just at year-end?
You can do it at year-end, but it's often better, as our source suggests, to be opportunistic. Treat it as an ongoing process.
So whenever the market has a pullback.
Exactly. Market dips during the year can create great harvesting opportunities. Don't just wait until December and scramble. Be proactive throughout the year.
And I guess technology helps here now, too. I've heard about robo-advisors doing this automatically.
Absolutely. Many robo-platforms now offer automated, often daily, tax loss harvesting. They're constantly scanning your portfolio for these chances.
That takes a lot of the burden off the individual investor.
It really does. But there's an important caution here.
Okay.
Don't let the tax tail wag the investment dog, so to speak.
Meaning?
Don't sell an investment just for the tax loss if you still fundamentally believe in its long-term prospects and it fits your strategy.
Right, because if you sell it, and then it rebounds strongly while you're in the replacement investment.
You could miss out on significant gains that might outweigh the tax benefit. So only harvest losses on positions you're genuinely okay with selling or swapping out for something similar.
That's a crucial balancing act. Investment thesis first, tax optimization second.
Exactly. And remember, those losses carry forward indefinitely. So even if you generate a big loss in a down year, you don't have to use it all immediately. It builds up in your loss bank for future years.
So a bad market year can actually create future tax benefits.
Correct. It's particularly valuable, as you might guess, for people in higher income tax brackets. The higher your tax rate, the more valuable each dollar of loss deduction becomes.
Makes sense. More tax saved.
And, for more advanced investors, TLH is often paired with other strategies like discipline rebalancing and asset location, deciding which types of accounts hold which types of assets for maximum tax efficiency. But the core TLH idea is powerful on its own.
Okay, so wrapping this up, tax loss harvesting. It's a really valuable tool. Seems almost like a free lunch in some ways for taxable accounts.
Close to it, yeah. Low risk, potential for real reward in after-tax returns.
By capturing those losses, offsetting gains, even offsetting some regular income, you keep more money working for you. The key things to remember are avoid that wash sale rule meticulously.
Super important. Know the 61-day window.
And maintain your investment strategy by reinvesting immediately into something similar, but not identical.
Keep that asset allocation on track.
It really shows how these, seemingly small, consistent optimizations can add up.
Absolutely. And that leaves us with a final thought, perhaps. Think about how these kinds of strategies, these consistent small optimizations like TLH, often overlooked, maybe seem a bit complex at first, how they compound over the long run.
Yeah.
It's not about chasing crazy returns or taking huge risks. It's about smart, thoughtful management of what you have. It can make a really substantial difference in your long-term wealth, maybe more than many people realize is actually within their control.
So the question becomes, where else in your financial life could applying that kind of strategic, efficiency-focused thinking unlock hidden value?
Exactly. Something to ponder.
Definitely food for thought.
Well, thank you for joining us on this deep dive into tax loss harvesting.
My pleasure. We hope this helps you feel better equipped to make your money work even smarter for you. Until next time, keep digging deeper.